First of all, Nerina, if we can start with the rationale or the criteria that a stock needs to have to be included in the Nedbank Green Index.
Right, I think it's a very important and good way to start because I think so many people hear the word green and they already have their own association in terms of what does green mean. And I think people find it interesting then to see that you have companies that are associated with dirty industries in a green index. So maybe to clarify that, it is more important for us about companies that acknowledge that they have an environmental impact and are actually doing something about it and are on this journey to mitigate the impact that they have, and thereby also not only improve the sort of the environment or is beneficial to that, but from an investment point of view, therefore represents those companies that actually offer the best growth from an investment point of view because they are doing these environmental things. So to answer the formal sort of part of it, it is based on the Carbon Disclosure Project, which is a not-for-profit organisation in the UK, which has the largest corporate database in the world of environmental information around companies. On an annual basis, they survey the largest companies in the world, and in South Africa, largest companies mean the top 100 companies that are listed on the JSE. It is a voluntary survey, but in South Africa has got actually one of the best participation rates. 83% of our top 100 companies participated last year. So really a good reflection in terms of how serious South Africa and the South African investment community takes not just the environmental impact, but certainly the entire ESG spectrum.
And so some of these disclosures, Nerina, are found in the sustainable reporting portion of the annual report. So you can actually go and see what a company's disclosed to the Carbon Project.
That's exactly what it is. So this whole drive around integrated reporting, as you say, the sustainability part of that speaks exactly to this. And just as a corporate finance component of the investment bank at Nedbank, also engages very closely, of course, then with many of these companies in terms of really the management processes and styles that they follow in terms of.
Let's talk about a couple of the stocks. The highest weighting in the Nedbank Green Index is given to Goldfields. So Nick Holland and his team doing something right.
Yes, absolutely. You know, I love telling the story about the project that they initiated at the Beatrix mine, and which they now actually are rolling out to many of the other mines as well, because I think it really talks to how a company doing the right thing environmentally actually benefits both the financial bottom line and therefore also the investment bottom line. So what they find at the Beatrix mine is that the methane gas that is so dangerous in the deep underground mining, they extract that from the mine, and not only does that make safer conditions and better production sort of criteria in the mine, but very importantly, they use that methane gas to actually be an alternative source of energy. They actually make them less dependent on Eskom. They also then get carbon credits for what they are doing, which is something that actually has a value associated with it, so you can actually sell that and earn revenue. And it shows how through just one project, this company is able to actually benefit themselves in terms of the financial bottom line on 3 levels, and therefore also results in excess or outperformance from an investment point of view.
So if I just get this right, so what they're doing is they're getting companies to disclose, and you say South African companies have been very good at that, 86% disclosing this to the organisation in the States. And then they're getting points based on the amount of carbon that they're offsetting. In their operations?
Yeah, it's not just carbon offsetting. You know, I mean, certainly there is the carbon emissions as a major component of it, but it has to be verified independently. So this is not just the company saying they're doing certain things. Independent verification, and also it's about measuring.
So there is an audit process that takes place here.
Absolutely, there's an audit process, and it has to be based on the environmental plan that the company has got in place also. So this is not just about talking soft, airy-fairy stuff. This is the real things actually happening, being done, and they are measured on their performance. And every single year, those criteria get more onerous also. So it's not a case of, oh, we did something good last year and now we're okay and we don't have to bother with it anymore. It is a continuous journey to improving that environmental impact.
Okay, now the obvious question is tying it to rands and cents, and why it's great that we support these by perhaps buying the ETF. I'm not quite sure how we support these companies and these efforts by buying the ETF, but what does it mean from investment performance, and what's the philosophy behind creating an ETF like this? Because yes, great that they're doing well in their carbon, but we want these companies to make money and generate returns for for investors. So how do you tie the two issues together?
Well, I think it's because we find that by doing the environmentally correct thing, the companies actually are able, certainly on a longer term basis, to improve their financial performance, and that leads to outperformance from an investment point of view as well. And one of the things that we find fascinating that Carbon Disclosure Project has shared with us is that they find that management and companies who care enough about the environment to actually do the right thing for the longer in the on a sustained basis, those are also the companies that are managed in a more sustainable basis across the board. So it doesn't only relate to their carbon footprint or to their environmental impact. It really does relate about not a short-term focus in how these companies are managed, but rather about the longer term. And that is where your sustained investment outperformance comes from as well.
It's still a relatively immature environment in South Africa, isn't it? I mean, is it starting to is take-up starting to happen much more effectively now?
Most definitely. And Bronwyn, I do believe that it's related to government's efforts, not only in changing the regulations around how pension funds are monitored, but the drive around CRISA, the Code for Responsible Investing in South Africa. The majority of our asset managers and participants in the financial services industry are signatories to CRISA, and many of them also to the Equator Principle. So these things are increasingly being embedded into investment processes, the management processes of companies, and certainly we see from the auditing side also the integrated reporting requirements that are there. So these things are all part and parcel of a fairly broad-based change that we do see taking place, and the acceptance of it has become, I think, a lot better also once people appreciate that you don't have to take subpar performance from an investment point of view just by doing the right thing. You actually get superior performance by being invested in these companies.
Well, it's very interesting you raise that, because we've had the likes of Tracy One from Investment Solutions talking about how this responsible investing is being, from their perspective as a multi-manager, pushing into the active management side, and it's good to see that we're doing a similar thing on the ETFs. This is one aspect of responsible investing.
Yes.
When are we going to have an ETF from Nedbank that's called the socially responsible ETF? And
funny that you should
all
ask
these things?
that. You know what we would probably do is rather see 3 separate ETFs, so that that's these building blocks in terms of the E, the S, and the G, so that it can be used by investors in the proportions that they require. And yes, we are most definitely working towards that, because we fundamentally believe that it isn't just about the environment, it is also about the social and about the governance aspect as well. But when you create an ETF, you are extremely dependent on having a reputable and proper index that you can actually track. And in order to create such an index, you have to have reputable, independent data on which you base this. And I think that is why the E was the first one that we started with, because the CDP actually does represent this information for us. There isn't something readily available and easy to translate from measurements into an index sort of driver in the S and the G space just yet. But watch the space, we are working on it.
Nerina, I know I've asked this question of you before, and that is that many eyebrows are going to be raised when British American Tobacco is second in your weighting, or in terms of your weightings, in the Nedbank Green Index. And I know you've said it's about the policies that a company is deploying in terms of bettering the environment, but surely that should have been discounted somewhat?
You know, I think it's because you sort of think in terms of BAT associated maybe with social responsible investing, or sin investing, or what do you call the alternative to sin investing, I guess. BAT and the likes of companies like SAB Miller even and so on are often associated with companies that are excluded when you talk about broad-based socially responsible investing. But really it relates to the health issues that are associated with British American Tobacco, and it's got very little to do with the environmental impact. And this is a company that does actually engage very actively in implementing policies to actually reduce not only their own carbon footprint, but through the value chain of the company also address that issue. And that is why they are a worthy high weight in the B Green Index and ETF.
Okay, just to move away from that for a little while, Nerina, we've seen quite a dramatic change in the way investors are using ETFs overseas.
Yes.
And one of the things you pointed out is that the ETF industry has seen record inflows this year. What's your perspective on what's driving the changes overseas, and why haven't we seen an order of magnitude change in South Africa yet?
We certainly see those changes in the US, to a large extent also in the UK, and as you rightly point out, not nearly to the same extent in South Africa just yet. And I think what is driving the change in the international markets definitely starts first and foremost with the so-called price war, or this reality that the world is faced with relatively low single-digit returns, and when you look at it on a real basis, often negative returns. So where and how can you actually eke that little bit of extra return out of your investment? Well, one of the first steps of actually improving performance is to reduce costs.
Right.
And that is what makes these passively managed investment vehicles so attractive to investors across the board. Why then has it not really taken off to the same extent in South Africa? Well, we actually find that there's a lot of passively managed funds being managed in South Africa, but the ETF space per se has not grown that significantly just yet. So what I'm referring to is one can have the same underlying index, let's say the top 40 index or our B Green index, which can be managed either on a segregated mandated basis or as a unit trust or as an ETF. It's exactly the same basic underlying investment, but how it is wrapped is really what determines the difference. And in South Africa, the ability for a broad range of investors to actually buy and trade in the ETFs is not facilitated properly yet. And that really relates to the LISP platforms, the Linked Investment Service Provider platforms, which really facilitates the majority of flow in the sort of the non-private investment space. And that's really where
So we need an overhaul to the system.
Barrier of entry really resides there, yes.
Are those barriers to entry going to be broken down anytime soon?
We're definitely seeing some of the list platforms making definite roads into introducing ETFs directly onto their platforms. Often you find that they are offered via the sort of the personal share portfolio or the equity component of it, because they are listed securities, but we are increasingly seeing that the LISPs acknowledge that this is the direction that they actually have to develop their own businesses in order to remain relevant to the industry.
Okay, just one other question. I mean, you know, we've seen the amount of ETFs morph over the last 5 years. I think we've gone from 20 odd to almost double that now.
Yes.
How do you advise? You're obviously, you've got a biased opinion here, but we've seen the performance of your equally weighted ETF, which weights the constituents of the top 40 all by the same weighting of 2.5%.
Right.
How do investors start thinking about how to incorporate these smart beta products into their portfolio along with the traditional ETFs? I mean, do you have any hard and fast rules as to what investors should do? Because it's now becoming an active decision trying to make the choice as to which passive strategy one is going to follow.
I think the only hard and fast rule associated with it is that you actually need somebody to help you through the process. If you are an individual investor, if you're not going to be doing the homework yourself, and there are the facilities available to do it yourself, but if you're not going to do that, best you use a financial advisor that actually do understand what these different ETFs represent and which one of the many ETFs that are available is the most appropriate for your investment portfolio. If you are an institutional investor, similar sort of story, you better know what is it that you're looking for in your investment. And it's not about the past return, or it's a risk-adjusted return first and foremost, but secondly, very importantly, what is the process that decides on the choice of these stocks, and does that represent something which is consistent with my investment philosophy, with my investment requirements, with the liability profile of the fund in which I invest. So there's no one size fits all, or you know what, this ETF is the best for everybody always. Not at all. They all have their own unique role to play.